Welcome everyone to Vested Interest. This is Shane, and in this video we are going to cover the four stocks I am looking to buy in the month of February. These won't be the only ones, but these will be the ones I primarily focus on. Obviously, if some other stocks jump in and present undervaluation, I'll add to those as well. These are all existing positions. We will take a look at those existing positions as well as some of the criteria here for these companies that I look at on a high level in the video. But before we do that, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to the subscribers of the channel. I really do appreciate it. For those of you who may be stopping by for the first time, on this channel, we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks, in growing companies with positive cash flow that covers the dividend, and companies with a high return on their invested capital. I dollar cost average into the portfolio on a weekly basis. I do a portfolio update every Sunday, so tune back in for that as well. It is free to see what I'm doing in the portfolio. I don't have a paid Patreon account. I'm not trying to get you to sign up for any mailing lists or send you into any other websites where you have to sign up for anything as well. But if you would like to help out the channel, if you could do me a big favor, hit the thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that subscribe button down below. Click the notification bell so you're notified whenever I put out any new content. Again, I do this video series once a month as we enter a new month, or right before we enter a new month, where I cover the stocks I'm looking at. I also do a stock pick of the day series Monday through Thursday whenever the market's open, as well as I already mentioned the portfolio updates every Sunday, where I cover what I've bought for that week, anything I've sold, any activity in the portfolio like dividends received, that sort of thing. There is a thanks button down below for anyone who would want to buy me a cup of coffee, and go ahead and click that button. There's several tiers down there. Really appreciate everyone who can do that. And again, special thank you to the subscribers of the channel. Really appreciate everyone who's taken the time to watch the channel, and hit the thumbs up, the subscribe button, and the notification bell. It doesn't cost you but a couple seconds of your time, and it really does help out the channel. Thank you. Thank you. All right, let's get into the first of four here. Occidental Petroleum Corporation, ticker OXY. This is out of the energy sector. This is a gas and oil company here. This is also one in Warren Buffett's portfolio. He started buying these, I believe, in the $50 to $60 range, somewhere in there, maybe even the $60 to $70 range. I didn't see the value there, but under 50, I'm definitely seeing it. It does have a 52-week range as low as $45.17, as high as $71.19. So it is pretty close to its 52-week low right now. It does have a beta of 1.59, so more volatile than the overall market. I'm trying to use that volatility to my advantage, right? Buying whenever it's on the low side of that volatility, and then holding as it runs up. I've been buying, I believe, around $51 and lower. We'll see my cost basis in my position here in a minute. Analysts do call it a hold. I'm a little surprised by that. They have a price target of $60.56, would represent a potential 29.82% upside. Anytime you can get nearly a 30% upside potential, I mean, I'd consider that a buy, but they're calling it a potential hold. Maybe they see a prolonged downturn here. Maybe that's the reasoning there. Earnings date is coming up February 18th, so that'll be here in the month of February. We are February 1st, the first day of the new month here. So usually you have either a big pop or a drop around earnings, so tune back in for that, right? If they were to report bad earnings or negative future outlook or something like that, might be another potential big drop. EPS is $3.84 per share. Price to earnings ratio currently is $12.14 per share. A little higher forward P at $13.99 per share. Dividend is 88 cents on the year. They are quarterly payers, to divide by 4. Decent starting dividend yield of 1.89%. Obviously, that has gone up significantly with the recent pullback here. Ex-dividend date was December 10th. We're well past that. They did pay out on the 15th. Now, I like to look at dividend yield theory to see if a company is potentially undervalued. That's going to be a little skewed on this one because they did have a dividend cut over the last couple of years here, last few years anyway. So it is going to skew their dividend yield a little bit, or dividend yield theory anyway. But to look at dividend yield theory, we look at their 5-year dividend yield average of 3.76%. Compare it to the current 1.89%, or over here where it says 1.8%. A little bit difference there because some of this information, like here on the left, is from stockanalysis.com. Some of this is from Yahoo Finance. I pull information from multiple sources. I don't just blindly choose one. I recommend you do the same. Don't just blindly trust one source. Make sure you're back checking sources to make sure the information you are getting is accurate and up to date. But anyway, 1.8, 1.89, pretty close. But since their current dividend yield, 1.8 or 1.89, either one is significantly higher than their 5-year average, that would usually speak to overvaluation, right? If this number was, if their current dividend yield was higher than their 5-year average, that would speak to undervaluation. The numbers are inversely correlated. But since they recently cut their dividend within the last 5 years, that does skew this one a little bit. Now, their payout ratio is low at 23.01%. Part of that is because of that dividend cut. Dropping down, I like to look at return on equity and return on invested capital as well. I like 10% or better for both of these metrics. And a lot of these metrics we're looking at here, again, I utilize for a quick high-level review of a company. You'll find that in my Stock Pick of the Day series. We run through my screener. And so some of this, not all of this, is kind of in line with that video as well. So good reason to tune back in for those videos as well. You can understand what my screener looks like. But getting back here, return on equity is at 13.12%. That's over the 10% I like there. Return on equity is a little bit, return on invested capital is a little bit low at 6.43%. Again, I usually like 10% or better there. EPS growth is above the 5% I look for. I like 5% or better forecasted over the next 5 years. So they're at 6.84%. They did not list revenue growth, which usually leads me to believe that they expect negative revenue growth. Dropping down to free cash flow. I want growing free cash flow over time. Typically, if a company has growing free cash flow, it's not only a growing company, but it also can do some things with that free cash flow. It can pay down debt, make acquisitions to reinvest back in the company. It can pay out a dividend, buy back shares, and it can raise that dividend over time, right? And as a dividend shareholder, I want dividends that are going up over time. Going back to December 2021 here, you can see 7.6 billion in free cash flow. Big jump up in 2022 to 12.4. I believe here in 2023 or 2022 is whenever they lowered the dividend there. I'd have to go back in time and look. But they did drop significantly in free cash flow as well in December 2023, only back to 6 billion. And the trailing 12 months, which would be all of 2024 right now, 4.5 billion as well. So really, since 2022, they've been decreasing in free cash flow. Hopefully, they've bottomed out and are heading back up. They have been repurchasing shares, though, also. 8 million in 2021, 3 billion in 2022, 3.4 billion in 2023, back down to 196 million in the trailing 12 months. So again, most all of 2024 here. Now, dropping down, lastly, we'll look at my position. Again, I am long Occidental. I've been adding to this one since late December, shortly after their December 10th ex-dividend date. Shortly after that, I started adding, so I did not get their January dividend, but I should get the next one. I currently have 122 shares. I've been adding to this one pretty aggressively, 10, 12 shares a week here since December, mid-December there. My cost basis is $49.57, so I am down 5.89%, but I don't mind that. I'm actually excited that it's pulled back significantly so I can continue to build this one out. I'd like to get this to at least 200 shares, have about 10,000 of my own funds invested into it, and then let it ride probably is what I'm looking at on this one. We'll see. That's as long as it stays, right around my cost basis. 51 or below is kind of where I like this one. So that's number one. Number two is Comcast. We're talking about Comcast Corporation, ticker CMCSA. This is out of the communications sector, and this one also has a big drop this past week, currently at $33.66 per share, at least as of the close of business on Friday. 52-week range as low as $33.30, as high as $45.82. So another one right up against its 52-week low. A beta, another one that is just slightly more volatile than the overall market. Again, I'm trying to use that volatility to my advantage. 1.01 just puts them a tick over. Analysts do call this one a consensus buy. Price target of $46.23. So they see a new 52-week high with a potential 37.34% upside. Earnings date coming out, or did come out on January 30th. That was probably the reason for the drop last week. Though I have not checked out the earnings call yet, so I'll have to take a look at that and see what they said. EPS is $4.14 per share. Current price earnings ratio is $8.13 with a lower forward PE at $7.86. Excuse me. Dividend is $1.24 paid on the year. Again, divide by 4. They're a quarterly payer here. They do have a very nice starting dividend yield of 3.68%. Ex-dividend date was January 8th, so unless you owned them January 7th or before, you wouldn't have gotten the dividend on the 29th that they just paid out, right? I did receive that dividend in my portfolio last week. Again, jumping over to dividend yield theory here, we look at their 5-year dividend yield average of 2.41% compared to their current 3.68, or over here 3.34. There's a little bit of discrepancy there. This is why I like to look at more than one source. But either way, let's call it 3.3%, still higher than their 5-year dividend yield average, which speaks to undervaluation on this one, at least according to dividend yield theory. Another one with a low payout ratio, 32.88%. Again, I like under 75% if I didn't mention that on the previous slide. So I feel that if it's under 75%, they're safe. That means they still have 25% to pay down debt, make acquisitions, reinvest back into the company, buy back shares, or raise that dividend over time. So this one is very safe in my opinion, as was Occidental on the first slide. Now, return on equity and return on invested capital. Again, I like 10% or better. Return on equity at 18.7% beats that metric there. Another one where return on invested capital is a low at 7.82%, so under the 10% I'm looking for there. EPS growth, it forecasted at 7.36, which beats the 5% projection that I like, and a estimated 1.45% revenue growth over the next 5 years as well. Now, looking at free cash flow, again, I want growing free cash flow over time. December 2021 here, you can see $17 billion in free cash flow. 2022, $12.6 billion. Back up slightly in 2023 to $12.9 billion, but then same thing down again over the trailing 12 months. 2024, they're at $10.9 billion. They are repurchasing shares again, $4.6 billion in 21, $13.3 in 2022. 2023, $11.2 billion, and trailing 12 months, $2.4. Now, I would really say this is similar to what we saw. They've kind of been decreasing since 2022 here, because even though it went from 12.6 billion to 12.9 billion, they dropped their share repurchase, right? So it looks like they've actually been decreasing since 2022. 2023, maybe flat, pretty close to flat, or slight decrease, but definitely a decrease in 2024. So hopefully they've bottomed out as well, and we'll see the upside from here. Now, they did repurchase, or they did announce a repurchase share program, so that means they are going to be buying back more shares of their stock, which should help their earnings per share over time. Another one I am long here. I do have 252.23 shares here. My cost basis is $40.52. So at $33.65 or 66 cents, it is well below my cost basis, down 16.92%. This is another one I want to continue to build out this position while it's under my cost basis. That will decrease my cost basis, increase my yield, and increase my potential future returns. All right, number 3 on our list is Sysco Corporation, ticker SYY. This is out of the consumer staple sector, closed out the week at $72.92. 52-week range as low as $69.03, as high as $82.89. Another one pretty close to its 52-week low there. And another one with a beta more volatile than the overall market, 1.18. Now, analysts do call this one a strong buy. I don't understand their criteria here for a buy, strong buy, or a hold. Because if you can see, this was, of the 3 we've seen so far, the lowest projected upside at 16.57%. But they called Occidental a hold with a potential of 29% upside. And Comcast just a buy with a potential, 30+% upside. But anyways, that's just the way it is. Price target potential of $85 per share would represent a 52-week high, a new 52-week high, and again, a potential upside is 16.57%. Earnings date was January 28th. I have not looked at this earnings call. I might want to go look at that and see what's going on there. Maybe part of the reason for the drop. Now let's jump over and look at. Let's finish this one out. EPS, $3.90 per share, PE ratio of 18.68. Currently, they see a lower forward PE of $15.42. Dividend is $2.04. Divide by 4. They're a quarterly payer. Nice starting dividend yield of 2.8%. Ex-dividend date was January 3rd. They did pay out at the end of January there on the 24th. Another one, I received the dividends, I think, last week or late the week before. Maybe it was last week. But looking over to the right, we're going to look at dividend yield theory again. Going to do that, we look at their 5-year dividend yield average of 2.56%. We compare it to its current, either 2.8 or 2.6. Either way, both of them are higher, so potentially undervalued slightly according to dividend yield theory. Another one with a payout ratio under 75, they're at 51.93. So in my opinion, definitely safe as far as the dividend. Not concerned with a cut on this one. Jumping down, again, I like to look at return on equity and return on invested capital. Return on equity at 86.51%, smoking high. Return on invested capital at 14.24%. So very nice numbers overall. They do have an EPS forecasted at 13.33%, which is above the 5% I like, with a nice forecasted revenue growth of 4.89%. So overall, the numbers on this one, at least on a high level, look pretty decent, even though this is one of the lower expected potential upsides here. Looking at free cash flow going back to June 2022 here, you can see $1.1 billion. June 2023, 2 billion. June 2024, 2.1 billion. Trailing 12 months, which is basically all of 2024 plus some of 2025. Now 1.8 billion. We'll have to see how that shakes out. This is really negligible. I should have went back to 2021, but it is what it is. You can do that if you go to Yahoo Finance, stockanalysis.com, whichever source you want to go to. You can go back a little bit further here and see what 2021 numbers look like. But looks like nice growth, slow growth, but it's growing free cash flow. All right, and another one I am long on. I do have 117.57335 shares. I am up on this one, 5.43%. So this one would be one of the rare occasions I'm bringing my cost basis up, but not a lot. It's within 5%. So I'm not real concerned with that, and I want to build this position out to where it's, buying one share every time it pays out dividends would be nice. So my cost basis is $69.17. It's currently at $72.91, close enough where I'd like to add to this one. And like I said, continue to build this out. And the last one, but certainly not the least, 4 of 4 here. We're going to look at LyondellBasell Industries, ticker LYB. This is out of the material sector. Closed out the week at $75.70. 52-week range, $72.21 to a low for a low and a high of $107.02. So another one pretty close to its 52-week low. Another one with the beta over 1, so 1.08. So I'm trying to use that volatility to my advantage. When it pulls back, buy. When it runs up, hold. Analysts call this one a hold. So another one they call a hold. And again, I just don't understand. If you see a potential 25% upside, I don't know why you wouldn't buy, but okay. Price target estimate of $94.77. Not quite back to its 52-week high, but again, a representation of a potential 25.19% upside. And if I can get 25% upside on a stock, I'm going to buy it. Not that I definitely agree with their price target. I'm just saying that's kind of a no-brainer in my opinion. EPS is $6.57 per share. Price earnings is $11.53 per share with a potential forward PE slightly higher at 13. Dividend is $5.36. Again, they are quarterly payers, so divide by 4. Very high, the highest dividend yield of the 4, 7.08 currently. Part of that is because of the pullback, obviously. Ex-dividend date was December 2nd. They did pay out on December 9th. So if you were to buy them now, you would get the next dividend, but you're going to have to wait a few months to get it, or a couple months now that we're in February to get it. Again, looking at a dividend yield theory, we look at their 5-year dividend yield average, 5.26%, compared to its current 7.08 or 7.04. And since it is higher than their 5-year average, that speaks to potential undervaluation. Now, this one is the only one of the 4. I am starting to get a little concerned on the payout ratio. It's just slightly above the 75% I like at 78.6%. So worth keeping an eye on there, but I don't believe it. It's been above that for the last several years. I've owned it, so I'm not as concerned. It seems they just run higher payout ratio than a lot of other companies. So it is what it is. Now, return on equity, return on invested capital. Again, I like 10% or better for these metrics. Return on equity beats that at 15.86%. But again, return on invested capital a little low at 7.12%. I'd like that to be a little higher. EPS growth is forecasted at 9.64%, which is above the 5% projected over 5 years that I like. Another one where the revenue growth, though, is forecasted to be potentially negative at 3.77%. Now, jumping over to free cash flow again, 2021 here, December 2021, you can see $5.7 billion in free cash flow. 2022 dropped down to $4.2 billion. 2023 dropped further to $3.4 billion, and trailing 12 months, which represents 2024 there, $1.5 billion. So it definitely looks like over the last several years, this is decreasing free cash flow. So you want to keep an eye on that as well. I'm not as concerned with this one, but you would definitely want to do more of a deep dive into the financials. Are they starting to bottom out? And this is, keep this in mind too, this is a cyclical company. So I feel like we may be on the downside of that cycle, and then hopefully I can ride the cycle back up on the other side. Now this one is probably the biggest gamble of the 4 that I'm looking at, but I'm willing to take that gamble. Doesn't mean you should. You should understand what you're buying. Definitely looks at the financials of this one. There is some concern on this one because if it continues to decrease, then it might not be worth, the juice might not be worth the squeeze here, but that's up to you to decide. It is for me. Looking again, another one, I am long LyondellBasell. All of these companies are existing positions that I'm trying to continue to build out. Currently, I have 150.68592 shares. I am down again 12.12%. My cost basis is $86.14. Now that it's under my cost basis is significantly 12.12% down. I want to continue to build this one out, bring up my dividend yield, bring down my cost basis, and bring up my potential future returns. So that is part of the reason I'm looking at this one as well. So those are the 4 that I'm looking at. Let me know what you are looking at for the month of February. Again, these will not be the only stocks that I invest in. If they were to run up past my buy point, then I would obviously back off and look to invest somewhere else, or just look to roll more funds into the other 3. But these will be the ones I start the month out focused on. Obviously, that will shift depending on what the market does over the next month. Love to hear from you in the comment section down below. What are you buying for the month of February? What have you been adding? Are you part of the downturn, a down push on a lot of these stocks? Have you been selling anything? Let me know in the comment section down below. These are some other stocks, in my opinion, that I believe are right now presenting a little undervaluation, or at least fair valuation. You know, Johnson & Johnson might be more around the fair value than undervalued right now, but still might be worth a look. Pfizer is one. Kraft Heinz. General Mills is actually not in my portfolio. Most of these are in my portfolio. General Mills is not, but I do see some value there. Havertys Furniture Companies. Genuine Parts Company, another one that's not in my portfolio, but I think it's undervalued currently. CVS. Chevron, again, not in my portfolio, but I see some value there. Valet has started to recover a little bit. It was down in the 8s. I think it's down in the $9 range, not right now, but still I see some value there. Nutrient Solutions, right around fair value, if not slightly undervalued. Johnson & Johnson, like I said, maybe right around fair value, if not slightly under. And American Water, I did recently add to this as well. So another one I wouldn't mind nibbling on. It's right about my cost basis now, maybe 1 to 3% over. Wouldn't mind adding a few more shares there. And there's others. These are just some of the ones that are in my portfolio or that I'm seeing currently. I wouldn't mind adding. If I was to drop a position out, I wouldn't mind adding Genuine Parts, General Mills, or Chevron. But the rest of them, they're in my portfolio, and I see some undervaluation in them, or at least fair value. All right, that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think of the video. What do you think of the 4 companies that I'm looking to add to? What are you adding to? And again, don't forget to hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics down below. So drop them in the comment section. I'll try to get back to you. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm only sharing my opinion. Investment journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.